Hey guys, this is Tyler, and today I'm going to be presenting on compensated absences, which is found in GASB Statement 16. According to Statement 16, a compensated absence is an absence for which the employee will be paid. So basically today we're looking at how the government accounts for vacation pay, sick pay, sabbatical pay, etc. And according to page 143 of our textbook, this is only accrued if A, the employee's right to compensation is based on services already performed. So for example, if you have vacation pay, an employee works to earn vacation days. And when the government pays those out, they're paying those out based on work the employee has already done to earn the vacation days. And B, it is probable the employer will compensate the employee through paid time off or cash at the time of termination or retirement. So if you have vacation time and you use it, the government is going to pay you for that time. And also a lot of government units and even companies have systems where upon termination or retirement, you will be paid out for sick pay or vacation pay that you have not used. And also according to page 143 of our textbook, this is accrued as an expense and as a liability. So under the modified accrual basis, an accrual is made only for the matured liability. So you only make an accrual for accumulated amounts that are due to terminated or retired employees who have not yet been paid for their unused sick pay or unused vacation pay. This amount must be measured using pay and salary rates at the time of the balance sheet, and it requires additional amounts for salary-related payments associated with compensated absences, such as the employer's share of Medicare and Social Security. I have two examples here, one to do with vacation pay and one to do with sick pay. First of all, for the vacation entry, for the vacation problem, in 2018, employees of Pecos River County earned $5 million of vacation pay. They were paid for $4.2 million, but deferred taking the balance of their earned vacations until subsequent years. Also, employees were paid $700,000 for vacations earned in previous years. So first of all, we're going to prepare the journal entry for the general fund to reflect the vacation pay earned in 2018. This is going to be pretty straightforward. For this one, we're only going to record what was paid out. So they paid out $4.2 million. Even though they earned $5 million, we only spent essentially $4.2 million in cash to pay out vacation. So that's all we're going to record right now. And now for number 2, prepare the journal entry to reflect the payments for vacation days that had been earned in prior years. This is dealing with the $700,000 up here. So what the situation here is that in the previous year, or multiple years, they did the exact same thing that happened this year, where they earned a certain amount of vacation pay, but then only used part of it. And that deferred the difference to later years, and it happened that that deferred difference, $700,000 of that happened to be paid off this year. So that's what we're going to record right now by debiting $700,000 to vacation expenditures, and then crediting the same to cash. Crediting the same to cash. Now number 3 is how will the schedule of long-term obligations be affected? Now this is dealing with the deferred amount from this year, which is $800,000. So that $800,000 is going to be added to the schedule of long-term obligations because we are going to have to pay that deferred pay later on in subsequent years. But we're also removing $700,000 because that was an amount that was already on the schedule from the previous year that we have now paid off. So we're going to have $100,000 added from this scenario. And number 4, prepare the entries if they are being put on the government-wide financial statements. The government-wide statements are going to be different from the entries used for the general fund. We're going to have the expense and the liability that I mentioned earlier in the presentation. First of all, to vacation expense, we're going to debit the full $5,000. And then to cash, we're going to credit the $4.2 that we paid. And to vacations payable, we are going to put the difference of $800,000. We're putting this into a payable because this is an amount that we are going to have to pay off in subsequent years. And for our sick pay example, we have Lemon County permits employees to accumulate any sick leave they do not take. If employees do not use any accumulated sick leave, then they will be paid for those days upon retirement or termination up to a maximum of 45 days. In 2018, employees earned $4 million in sick leave. Of this amount, they only paid $3.1 million. The county expects that they will be paid $600,000 as they take sick days in future years and $200,000 upon retirement or termination. The balance of $100,000 will not have to be paid. So for number 1, prepare the journal entry in the general fund to reflect the sick leave earned and paid for 2018. We're going to debit to sick leave expenditures the amount that we paid, just like in the previous problem, which is $3.1 million. We're also going to credit that to cash. Now, for number 2, indicate the amount to be reported in the schedule of long-term obligations and the government-wide statements. This is basically dealing with 600,000 and the 200,000. Now, the rationale for why we are only recording 3.1 million is because we are working based off of the modified accrual basis of accounting, which means we only report items that happen currently or in the first 60 days of the next period. And the only item here that fits into that description is the 3.1 million, because that is what we are physically paying right now. The 600,000 is purely an expectation. We don't even know if that will be paid off next year or the year after, so we can actually just ignore that completely. That's just purely forecasting, and we don't need to worry about it in this problem. The 200,000, however, while it is not current, so we would not record it in an entry, we are still going to put in the schedule of long-term obligations because we are still responsible for the retirement and termination. Because unlike the 600,000, we know for a fact that this 200,000 is going to eventually need to be paid out when people retire or are terminated. We are not paying it out now, but we know for a fact that we will need to do it in the future, so we will still put that 200,000 on the schedule of long-term obligations. That concludes my presentation. I based it off of a video by Professor Farhat. Thank you for watching.